Queen selalu. Semua kita.
Okay, let's get started, guys. I've already put in this chapter for you. I'm going to put in this chapter for you. Finish up this chapter first.
Okay, sir.
3 hours. 3 hours.
SST.
SST.
SST 3 hours. Okay.
Yeah. I'm putting chapter 5 also first.
The five is about
Control transfer.
Itu berapa hours? Dia berapa chapter?
Control transfer is related to, repeat, related to capital allowance and IBA. Okay. Control transfer, then estate you finish already. This one is going to be, chapter 10 is
Chapter 10 SST.
SST. So this one try to finish up. This one should be fast. 20 minutes, 30 minutes can finish it. The knowledge is 20 minutes. The case study is about 30 minutes. Question practice. Are you okay? Can?
So this one we only be covered in video lah sir. Okay.
Can
How many chapter is it? How many chapter?
This one is one chapter. This one one more chapter. So this one try to finish off by
10, 5.
Can
10 and 5.
10 and 5. 10 and 5.
Okay.
Okay,
Chapter E.
Next, we're going to go into, so remember you have a sales and service tax assignment, right? Those doing sales and service tax assignment.
Yes.
So that might help you lah. Do chapter 10 first lah. Do it quickly lah.
So what about chapter 8?
Chapter 8 I will put it next class.
Next class. Okay.
You do chapter 5 first. Because chapter 5 more related to your IBA and your CA.
Capital allowance.
Capital allowance.
Okay sir.
Okay, so now we're looking at listed investment holding company. Listed investment holding company, okay, the rule is, remember, listed investment holding company, the rule is, okay, have a look at this part, question 26. A listed investment holding company has a rental income of 40,000 and management service income of 60,000. Okay, it has a capital allowance of 22,000 for rental business and 3,000 for management services. Now, normally capital allowance can be deducted for rental, no? Yes, no?
Yes.
No. Okay. General admin cost is 60,000 to be shared on the basis of income. You also incurred a direct cost of 20,000 for rental business and made a donation of 4,000 during the year. Okay. Calculate the chargeable income and explain the treatment of items included. Okay, now let's look at the calculation first. So you have this thing that you have to calculate, and you should be able to get your have you okay this part so far? So you can get all of this. Let's go through one by one. The rental income, gross income is how much? 40,000, and 40,000 here is
60,000.
okay, do total up first. Direct cost available for rental is how much?
Direct cost. Direct 20k.
20k, right?
Yes.
Okay, shared cost. How much is the shared cost?
Share cost.
Shared cost is 60,000. You can minus
60,000.
based on
Divide.
can?
So what is the specific calculation, sir?
Huh?
What is the specific calculation?
Prorate 60,000
Times.
times 40 over 100,000. Prorate.
Oh, okay.
Shared on the basis of income. Income how much? 100,000.
Alright.
Okay. So here become nil. Yeah.
So one is 24.
So total 24,000. So capital allowance.
Yes. 2,000 for rental business. 3,000 for management service.
So here become
2,000. 3,000.
you pay this part.
So capital allowance for rental sebab
Huh?
dia berkait dengan business ke?
Which one?
Yang ni untuk rental.
For rental.
For rental.
It's because it's deemed business.
Oh, ada.
Source.
Team business.
Deemed business, not real business, but
Oh.
deemed business. Acah-acah dari business.
So it will be forever nil lah, sir.
No. If there's an income, you can minus lah.
Okay. So it's related to adjusted income lah. Okay.
Donation.
4,000. Cigarette kenapa tu? Oh, exemption 2,000 kan?
Which one?
Yang donation.
10%.
Oh. Oh, tak.
Cap to 10%.
Okay.
Adjusted income there.
10% of EI adjusted income.
Adjusted income kan 24,000.
Aggregate income.
Aggregate.
Aggregate income. So this one.
Okay. Oh, aggregate statutory. Alright.
Can? Follow. Can? So you will disregard, you cannot use the current year loss. So I'm just going to put a line here about current year loss. Nil. Can why cannot carry forward is because yeah. So next class I'll test you on RPGT and sales tax and also capital allowance.
Test.
Test.
Or like quiz.
Quiz test to see whether your knowledge is up to date or not.
Okay, sir.
That will be indicator whether I help you pass or fail.
Oh my.
If I see your mark 35, then I look at your marks. 35. Are you okay? Then I repeat again. I see your quiz marks. Then I look at your mark 35 out of 100. I leave it at 35 if your quiz is very bad. I adjust to 40 if your quiz is good.
Oh, RPGT dengan
Are you okay?
SST lagi?
RPGT, sales and service tax, sales and service tax, RPGT, then you also have what else?
Tu je lah.
Capital allowance,
The allowance this chapter ke sir?
capital allowance, RPGT, sales and service tax.
Chapter ni lah kan? Sini.
Boleh ya?
Itu yang awal-awal.
Yeah.
Capital allowance yang awal-awal hari tu.
Yeah.
Yang sebagi recording.
I gave you the recording before already.
Okay,
So next week I will do a test. The test purpose is just for you to show that you are working hard and therefore deserve to pass. Get really bad scores. Objective only. Objective and fill in the blank. Yes.
They already ascended to the sky.
Okay. Are we okay in this part?
For all calculation lah sir.
No, not all calculation. MCQ.
MCQ maksudnya ada yang definition, law and what kind of question?
Open book. Open book.
Open book, oh, okay.
Open book.
Boleh bawa printed paper.
You can bring your notes.
Dengan iPad kan?
No, don't use you have to use your iPad lah, but you have to use your notes lah. Paper notes.
Paper notes.
Refer notes. Refer your paper
Cannot,
notes.
cannot bring this.
Don't search inside your this one.
Okay, sir.
Okay, I will do a timer of 2 minutes or 3 minutes per question.
Okay, sir.
MCQ.
Berapa question?
Maybe about 20-25 questions.
Is it CPA level question?
Yeah.
Oh my.
10% off.
Duration sir 2 hours 30 minutes sir. 2 hours 30 minutes.
Pasal macam tak cukup eh.
Kalau dah 3 minit satu ni.
Kan?
Dah nampak kesusahan ni.
Tuition is capped at 10% of aggregate income and excess is disregarded.
Okay, let's move on. Let's look at this question here. Right, can you calculate the chargeable income for both years? Very easy.
Question 25.
Oh, 1.8 million.
Gross income, expenditure, depreciation. With tax.
Depreciation ni macam tu. Depreciation sekali tadi.
Tadi macam tak
Tak masuk.
tak ada. Tak ada masuk. Pula dua tu lain.
Okay.
150k. Tolak dua tu je lah kan. 40k. Apa tu sikit ni? 140k. Yeah. We got 830 here. This is like
Tahan guys. Let's move on. PPT, what do you get?
One point eight kan?
Are you done?
Tambahkan depreciation. Tolak capital allowance 180,000 dengan 130,000.
Check at this.
Yes.
Yeah, it should be.
New. See if you get adjusted income to loss, terus nil rasa.
just the loss for the software and is recorded and that can be forwarded.
Tak penuh.
Yeah?
Tak penuh ke?
Are we okay then?
Storage ada 256. Tak.
Ada 256.
May I move on? Okay. Moving
Bagi
on.
public YouTube. Nak ke?
Boleh tak? Nanti bagi dia.
Okay, we're done with all of this already, right? Settle lah. Close already, yeah? Close. Okay. So we're moving on to international tax. Okay. What is international tax? Okay, international tax, one of the big ones that you get is withholding tax. Okay, you can get double tax agreement, you can get financing decision, setup decision, transfer pricing, labuan tax issue. So one of this will come out for about 10 marks.
Okay.
Does that make sense? One of this issue can come out for 10 marks. It can be withholding tax, it can be double tax, it can be financing. So this is one of the questions. Got it? So you already know there's one question called capital allowance, and what do you call? Capital allowance and IBA.
IBA.
Also agricultural allowance. Remember, there are 3 allowances that can come. That's one question. Inside that question, also control transfer can come in.
Dalam, okay.
Just, I want you to remember that the 3 is one package. What's that? That's 10 marks. 10 marks written question is IBA, AA, CA, and control transfer rule. That's why I'm putting the control transfer there so that you study as a package. Got it? Yeah, control transfer is not a complex idea. It's just when you have control transfer, capital allowance calculation can run. Follow? Okay, so that's one idea. The next idea you have is international tax. Now, the previous chapter that you saw, the one that you saw, the chapter 1 that you saw, is a wide chapter that can come for the individual tax, can come out for corporate tax, can come out in many places. Not specific to one chapter specifically. It is a everywhere chapter. Okay? Okay. I also gave you sales and service tax, which is 10 marks. Sales and service tax is 10 marks. Whatever I ask you will come from inside there. Inside that spot. Whatever I ask you for IBA or AA will come from inside the notes that I've given you. But of course, case study change lah. Can Okay, so withholding tax, whatever that can come out from inside this chapter. It's not withholding tax, it's called international tax. Alright, so first you have to understand the idea of scope of charge. Income tax will be charged upon any income accruing or derived from Malaysia or received in Malaysia from outside Malaysia. Income from any person other than resident carrying out banking, insurance, sea, air transport for year derived from source outside Malaysia and received in Malaysia is exempt. Okay, usually exempt for individuals. Okay, do make a note. This idea of international tax. Individual or foreign income received will be tax exempt. Individual is still tax exempt.
Only business. Only business that we have.
Only company, LLP, they are the one who will get it. Understand now? But if your partnership also kena. So here, there was a change in law. But the law basically says individuals, all foreign income received will be tax exempt. For now, for 5 years. For 5 years. Although the law is you're not supposed to be exempted, but for now they give exemption for 5 years. So on hold for 5 years. Understand? Okay. But company, LLP, partnership, trust, all foreign dividend, only foreign dividend received is exempt if certain condition is met. All other income is taxable. Okay.
You get sectors.
Yeah. So you might have to think about double tax relief to be applied in certain cases. Got it? Move on. Okay. Now, source of income. Employment is based on where the work was done. Rental is where the property is located. Okay. Dividend is where the company is resident. Service is where the service is delivered. Pension is where the fund is located, where the money is located. Manufacture where the product is made. Correct? This is called the derivation of income, where the income is derived, therefore subject to tax there. Clear? One of the questions that do come out is, which is better? Should a company, when a company plans to enter a foreign country, can decide whether to set up a subsidiary or set up a branch? Does that make sense? You can go set up a branch outlet or a subsidiary company. So if you set up a branch outlet, simpler to operate as there is less regulatory issues. Branch got less regulation. No stamp duty for any money you put in. Avoids withholding tax implication, returns for profit back. So when you have any returns, you have to return back, and you don't have any withholding tax on the issue. It also has no requirement for local shareholder being involved. So some countries have local shareholder requirement. So you can bypass that. No impact on asset transfer. So you transfer asset from parent to the branch, no control transfer rule. Okay, that's why I'm asking you to remember the control transfer idea. Then you got loss in branch may not be available for parent. That's one of the problems. Now, subsidiary, acquired or greenfield. Now, when you buy a subsidiary, either you set up, greenfield means set up from zero. Set up from zero. Acquired means you buy an already ready company. Now, better local image and higher chance of borrowing facility. If you have a Senam Berhad, it's easier to get money. Incentive grants are normally available for companies. So if you are a company, you can actually get most of the incentive government gives you. It provides justification for overhead because you have a company. Gain on sale of shares will not be taxed unless it is RPC. So you have to check whether the company is RPC or not. So usually when they sell the shares, there is no tax.
So RPC stands for?
Hey, haven't done chapter 3 video? Have I done chapter 3 video already?
No.
Not yet?
No.
Okay. RPC stands for Real Property Company.
Okay, sir.
Real Property Company. Alright? RPC is Real Property Company. Distribution can be timed and format can be capital or dividend. So you can also time it, and then retention of profit at a better rate until conducive to repatriate. So when the rates are better, you can repatriate. Like right now, the rates drop, so you can repatriate the money. That's a setup decision. Now the next one is called financing decision. How do you finance the business overseas? So if you go overseas, you might want to use either loan, debt finance, or you want to put equity injection. Are you clear the two parts there? So debt or equity into the subsidy by a parent. Now the following tax consideration should be made. Loan interest is tax deductible, so you can shift your profit. Does that make sense? You can deduct it for expense. So giving loan is a better idea, especially since the interest is tax deductible. Currency of a loan can be selected to suit parent requirements, so you can actually choose what currency you want to give the loan at. So you can avoid exchange rate issues. Loan can be flexible if they include conversion option. This is convertible loan. Convertible loan. Loan can carry lower rate of interest with premium on repayment or discount on issue. Does that make sense? So you might have a premium on repayment or a discount on issue. Last one, no stamp duty is required for loan arrangement between sub and parent. So if you have a stamp duty, there is no requirement for arrangement for this, alright? Between sub and parent. Now, share capital, what's the benefit? You can maximize your foreign subsidy retention. Limit the tax at home if there's no dividend, because dividend you only pay when you want to pay. So you don't need to pay, you can just leave the money retained. Are you clear now? Like the case of Google, you know, Google, they don't actually send back any money from their foreign subsidiary back to the home because they don't want any tax. So they avoid all the tax, okay? You know, right, Google's international tax rate, how much is it?
Don't know.
3%.
3%.
Their corporate tax, they earn billions of dollars profit, they only get taxed 3%. How? They use tax planning. Okay, now they use proper tax planning to reduce the rate from 30-40% down to 3%. They shift profit from high tax location to lower tax location. How is that done? Okay, so maybe I can show it to you here. Yeah, they call it the Irish sandwich. Okay, or the Dutch sandwich. Okay, the manure, the tax manure is called the Dutch sandwich manure. Alright? The Dutch sandwich is basically, you can see, Google Holding Netherlands, all the European companies pay sales into Google Ireland Limited. From Google Ireland Limited, they transfer to Google Netherlands Limited. From Google Netherlands, they transfer to Google Island Unlimited holding company in Bermuda. So when they do this move, they reduce their tax to 3%. Are you clear now? Now, making this movement 1, 2, 3 is where they kind of reduce their tax, because Bermuda has a tax rate of 0.1% or 1%, very low. Does that make sense? Yeah. So that's, you notice what they're doing? Shift profit from Europe, high tax rate, to Bermuda, low tax rate. Okay, so share capital. Tax incentive can only be triggered by having certain level of shares. You must have a certain level of share capital before you can apply for certain licenses. Okay, like for example in Malaysia, to apply for Ministry of Finance license, you want to apply for government contracts, the company must have a share capital of 2005. If they don't have 2005 or above, they cannot apply for MOF license. So that means you need to have a certain amount of shares. Got it? Next, overcome issues arising with bank covenant and debt. Because if you have banks giving loan, they will look at your gearing. So if you have shares, your gearing will be low. Now, better image with a company with larger share base. So if you have a large capital, large equity investment, people trust you more compared to a company with low capital. Alright? Now, one of the rules that comes into this idea of giving loan, remember giving loans, is this idea called earnings stripping rule. Okay? What happens is, limits the level of debt that can be raised, achieved by means of tax or exchange control. So it ignores third-party debt in some location. That's one of the things they can do. It covers all debt guaranteed by parent. Not only the debt given by parent, it also can be debt guaranteed by parent. Are you okay with the difference there? I give you debt is one thing. I guarantee the debt. You take from the loan from a bank, I guarantee the debt. It's also like I give you the. Are you clear now? So they're also looking at that already. Now, Malaysia has something called an earnings stripping rule. Now, what does the earnings stripping rule do is, notice interest is tax deductible, correct? Okay. However, if you trigger a certain limit, you will then not be able to deduct the interest. Okay, so restriction on deduction of gross income in relation to interest expense related to financial assistance in a controlled transaction. Okay, keyword financial assistance in a controlled transaction, which is in excess of the maximum amount of interest as determined. So there is a target interest level, how much you can actually deduct. There's a limit. Okay. Interest in all forms and payments that are economically equivalent. So any interest. Control transaction is between person of whom control over other party or control by third party. And financial assistance could be loan, could be interest bearing trade credit, could be advance, could be debt, could be guarantee also. Does that make sense? Okay, so what's the meaning of control? So the meaning of control here is Percentage of share ownership is 20% or more, and that means 20% or more is already there earlier, and also if there is dependence on IP, intellectual property, like in this case, intellectual property, see royalties? Dependence on IP already. So if Google Bermuda give any guarantee to any of these companies, it will fall into this earnings stripping rule and control rule. Correct? Supply, sale of pricing, and pricing is controlled by third party, or one or more directors of the entity is appointed by third party. So remember, it's 20%, not 50%. So even if you're an associate, you automatically can trigger this rule. Go down here. So the rule, make a note, jump here. Jump to this page. Restriction on deductibility of the interest. Okay. Special case for MNE, multinational enterprise. Usually only multinationals. Okay. Have external borrowing used in their local subsidiaries. So they set up a sub and they use foreign debt or any debt. Okay. Affects business interest. Other payments that are equal to interest. So anything that is deemed to be interest will be covered under this rule. Effective from 17/17/2019. Okay, control you already know. Alright. Financial assistance basically means loan, trade credit, interest, advance debt, or providing security or guarantee. Interest here. This is classified as interest in all forms, equivalent, which includes determining adjusted income but excludes guarantee fee. Interest expense that is not deductible from a business source. Okay, this one you have to underline this. So you mark this one. So you must know what interest is or what interest cost is excluded. Includes P&L share as per Islamic financing and any premium discount that's MYTAX. Focus is substance on what is interest. Now you already studied interest in FAR 3, yes, no? FAR 3, you're in FAR 3 now, right?
Dah habis dah.
FAR 4 dah finish dah?
Dah, done.
So you should have studied IFRS 9, how to calculate.
How to calculate interest rate.
Yes, no? Do you know how to calculate?
Financial instrument. Kan?
How?
So isn't IFRS 9 is for
Financial instruments, debt. Okay. Okay, now let's move on. So specific third-party interest restriction does not apply to the following interests. An individual, so individual not covered by this rule. Licensed bank or Islamic banks, Labuan Bank or Labuan Islamic Bank, all this not covered. Any Labuan entities also not covered. Any development financial institution, SPV under Income Tax Act. Now, what is an SPV? Some people call it a SPEC.
What
You
is
heard
it?
of SPEC?
What's that?
Special Purpose Acquisition Company.
Ooh.
SPAC. Okay? See? You list the SPAC, you get the cash, then you target a company to buy, and then you list the successor company. So something it works like that. So these are basically special purpose vehicles under ITA. Okay. Construction contractor or property developer, all those are excluded. They're not going to be covered. Now, there is a de minimis threshold. Okay, do you know the meaning of the word de minimis? Yes, no?
No. Don't know, sir.
It's actually, I think, if I'm not mistaken,
The minimis. I think it's Spain.
de minimis is Latin.
Latin.
Is Latin. Okay? Shortened version
that's
of
like
the
about
de minimis
rice,
non-current lex. So when they say the word de minimis, The law does not care about very small matters.
Oh, it's like immaterial lah, sir.
It's materiality level. Are you clear now? But in law. So for tax, we always use the word de minimis. Okay? You heard of that word somewhere else before? No? Never? Okay. So de minimis threshold means below 500,000 interest, no need to worry. No need to worry. It's immaterial. Okay, everything can allow, all the 500,000. You already saw this de minimis threshold for interest for overdraft. Remember, below 10,000 you don't need to worry, below 6,000 for individual no need to worry. Remember that? Same thing, it's the de minimis threshold. Got it? Okay. So, example, the following situation relates to two business. Okay, situation one business interest is equal to 500,000. Here, one business interest equal to 1 million. 4 business interest equals to 450,000. 4 business interest 1.2 million. Okay. Now, what will happen?
$600,000.
Below the
$300,000.
business situation 1 and 4. Okay? Follow? Okay. Follow? Last one. Call the situation 1. This is situation 3, yeah? Situation 1 and 3, okay? Can I just label this? 1, 2, 3, 4. Label this. 1, 2, 3, 4. Can I? So situation 3 is below, so no need to worry. Below, no need to worry. Here, 1 have to be worried. Here, have to be worried, but there's 4 businesses. Okay? We are getting spot.
So what does it mean by applied prorate?
That means you have to prorate the thing. You cannot You cannot do lump sum. You cannot do total. You cannot do like 1200 times 20%. You cannot do like that.
Oh,
You must take each business and do.
okay. Okay, sir.
This one you can do. This one you can do. Very clear, no?
Okay, sir.
This one you must do one by one. One business at a time. Okay? Alright, let's move on. The tax EBITDA calculation also. Okay, tax EBITDA calculation. Adjusted income before any restrictions of 1(4)(c). Okay, 4A sources only. Notice the word 4A sources only. Business source only. Got? Okay. Total deductions from double, special, further deductions. So any special deductions, any further deduction, all that add back. Yeah. Then C is going to be total interest expense related to financial assistance. It's not all interest, only those related to financial assistance. Okay. Okay. Now, calculation is fixed at a rate of 20% of tax EBITDA. So let's say company A has interest expense of 1 million and tax EBITDA of 4.4 million. How much is the interest allowable? Yeah. Right. So what do you get here? RM 4.4 million times
20%.
RM. Correct?
80.
880, right? Okay. Balance RM 120k, right? Can I? Is it 120? That's right.
Mm.
Are you ready to start?
120,000 tu dari mana sih?
Dia interest dia berapa?
Interest dia 1 million.
1 million minus 880.
Oh.
You can only deduct 880. Are you clear? No?
Okay.
Okay, are you clear ni deductible? Yes, no. Can I? Okay, moving on. Company B has interest income from all sources 1 million. Tax EBITDA is 4.4 million. Okay. However, all business sources have the following interest and tax EBITDA. Now you notice there's a difference here, right? Okay, and what did I say? You have to calculate one by one. So you have to calculate one by one. So here, the following interest and tax EBITDA. The first one is the interest, the next one is the tax EBITDA. Got it? So now you have to calculate one by one. Can you calculate and tell me one by one and tell me what's the limit? Okay, so I'll just show you this. Here you got business. 1, 2, 3, 4. So you got your. Notice the amount is the same. Huh? The amount is the same. Huh? Tax. Maybe you can calculate this one. Can you calculate and put the limit? Therefore, how much you can deduct?
So is it continuous question from example 1?
Yeah.
Okay. Tax EBITDA.
How much? So here, 520. 520. No, sorry. This is
27
2710. Next one is
630
630
310
310.
750.
This is a tax EBITDA, correct?
Yeah.
Notice that it's the same amount, huh? The interest also same, correct? 1 million, yes or no?
Yes. Interesting.
But interest, this one very important. How much is allowed? Allowed is 20%, correct?
Yes. 0.2
Times. Are you clear that there's only 20% allowed?
104.
Can I? That's the amount allowed. Follow ah? So should be, but notice I'm not putting at the total level ah. Okay. Interest that can be deduct. How much can deduct? Okay, here 520. Can deduct all?
Yes.
520. So there's no carry forward, correct?
Okay.
Here 200.
200.
So can deduct?
Yes.
Not all.
Yes.
Can deduct all?
No. Not
No,
all.
200.
1 to 6. So this one is 200 minus. Yeah, are you clear now?
Yeah.
Next one,
Uh,
130.
130.
So
Can.
here
62.
62 can deduct.
68.
Are you okay now?
Yes.
Okay, then here is going to be 150.
150.
150 lah.
No
Okay.
carry forward.
No carry forward. Okay. Are you clear what's happening now? So same situation, but remember you have to prorate already. Are we okay? The actual interest is total interest is still. Pay attention, if I add these two together, so it's 1 million. That's like the same as above here, remember? Understand now? Here, I could deduct how much? 880, right? Not. Okay, so here you see I can't deduct all already, but limit to this, less. There's some carry forward. Understand now? Okay. That was tax EBITDA. Unused interest can be carried forward but kept to the limit each year. Okay? Okay, that's about this idea of tax EBITDA. Are we okay in the idea of tax EBITDA already?
Yes.
Can I? Okay. That is interest restriction. Interest restriction come out because of one, you set up overseas using a subsidiary and you finance by loan. And the loan is special kind of loans. It's financial assistance which the parent guarantee or give direct. Got it? If the parent never guarantee or give direct, it's just a normal business loan, no need to worry, it's deductible. No effect. Don't put in the calculation. Are you clear in this part? So you must know what interest is affected by this and why the issue come up. The issue come up is one, they come to Malaysia. How they decide to set up? Subsidiary. After they do that, they say, okay, no equity, put all debt. Where the debt come from? Then you see whether there's a restriction or not. Okay, are you clear now? Now moving on. The next area we're looking at is something called double tax agreement, DTA. If there is a DTA, this is effective manner in solving double taxation that arise from operation of tax law for two different countries and promote world trade. Okay. All DTA are based on OECD and UN model, so there is a model document. Okay. It also provides tax evasion and avoidance. Also avoids tax evasion and avoidance by ensuring countries share their data. Now, a double tax agreement, if you look at it properly in online, you can find it.
Page berapa? Page 3 dia.
So if you go to Hasil, okay, the website, you will find this document. Does that make sense? This is double tax agreements. If you work in the international double tax, transfer pricing companies or transfer pricing division in the future, you have to sit down and study this document in detail. You must know every single aspect of the countries you are dealing. So if you are in Malaysia dealing with other countries, which country are you dealing with? You have to go through the double tax agreements. Okay, you have to know. That's what a double or transfer pricing specialist will do. Later on, you go to the Big Four and all that, you decide to join the tax consulting side, you can join the transfer pricing specialist department. What's your main job? This document. This is what they will go through. So, the look of the document, let's pick a country. Which country you want to pick? Any country you want to pick, guys? Japan? Look at Japan.
Japan. Boleh lihat lah.
Okay, so double tax avoidance agreement signed on this date. It was amended on 2011. Okay, now. So after that, the way it looked like, the double tax agreement will always look like this. Agreement between the government of Malaysia, government of Japan. Okay, then they say article 1, article 2. What's the income? Okay, now that's subject to this double tax. Like Malaysia is income tax, petroleum tax, Japan is income tax, corporation tax, local inhabitant tax, correct? Called the Japanese tax. Then they will tell you what are tax. Then Article 3, purpose. They define all the things, right? They define all the words. After that, you got Article 4, residency status. How to determine residency status. Article 5 is the definition of a permanent establishment. Then you have Article 6, which is what is the immovable property, Article 7, and they go on listing all the articles out. So in that sense, we'll say it is based on articles, got it? Okay. Now the principle is relief if two tax authorities tax the same source. That means you get taxed 2 times on the same income, got it? Next. Not to depart from domestic law of the contracting state. It means you cannot create a tax in the double tax agreement. Whatever tax must be what tax exists inside the, remember, whatever tax exists inside the country, not something added on. Not to impose tax if there's no such tax. Now DTA is a shield for the taxpayer and not a sword by the tax authorities. It cannot be used to charge tax if no tax exists. So in Malaysia, it must be under ITA, RTGT or SST. Got it? DTA supersedes any written law. So if there is a law and a DTA come in power, the DTA is more powerful than the law unless there is a law written after the DTA to specifically address the DTA. So the DTA will always stand. Now, one of the things you need to know about is this foreign businesses. Remember, is this idea of whether you get taxed when you are doing online businesses like TikTok. Okay, if you are a TikTok influencer and you are earning money from TikTok influencing, your operation is where?
Malaysia.
You are in Malaysia. Where is the website?
US.
TikTok, right? China, right? to be in China. So now how are you supposed to be taxed or China is supposed to tax you? Now who's paying you the money? Who's paying you the money?
China.
TikTok in China paying you the money, right?
Yes.
Yes or not? So now how? You get the money from overseas. So where is the income derived?
From overseas.
China or Malaysia?
China.
Malaysia.
Where is the TikToker doing his influencing?
Malaysia.
Where is his activity done?
Malaysia.
Therefore, income is
Malaysia.
Malaysia. That's called operation.
Okay.
Understand this idea or not? So you always like, don't get confused. Where's the operation?
Here.
Operation Malaysia. I don't care where the money come from. You earn here.
You have to pay tax here.
Does that make sense? So you get tax in Malaysia, lah? Okay. Those are ideas. So this is where it's looking at the whole system and seeing like where is the money coming from. So is the business operation in Malaysia? Notice that business operation in Malaysia, you get tax in Malaysia already. It's derived in Malaysia already. It doesn't matter where the website is. Are you clear? Could be China, could be Malaysia. It doesn't matter. But if you operate through a branch, then different story. Notice now the branch word come out already. If you operate through a branch, whatever the branch income overseas is branch income overseas. Okay, so only Malaysian income is taxable. Okay. Now over here, you operate through a branch overseas, and the website in Malaysia, or could be operating through overseas. You are a foreigner, you are Malaysian resident, tax resident, you stay in Malaysia, and then you go and operate in Singapore. So whenever you do your influencing, you go to Singapore. You travel to Singapore, you do the influencing 3 days, 4 days there. You take all your videos in Singapore. Are you clear? So that's why nowadays you see some TikTokers like to travel around the world, right? Overseas lah. Are you clear? So they go overseas, and their website could be in Malaysia. So are they taxable?
No.
No, because they didn't derive their income from Malaysia. The other one is resident and overseas same. Both also no. Okay, are you clear on the resident status already? Yes, no.
Yes.
Can okay. Here also same. It doesn't matter whether the person is non-resident or resident, as long as operations in Malaysia is derived in Malaysia, irrespective where the website is held. The person operates overseas, but the website is in Malaysia, there is no income derived in Malaysia. So now, big question. Netflix.
Oh, Netflix.
Mana?
They have branch kan, sir?
Their business operation is Malaysia or overseas?
Malaysia.
Sebab ada Netflix.
For Netflix Malaysia.
Ada Netflix Malaysia Sdn Bhd?
Tak ada.
Habis ada Netflix for Malaysia.
I know Netflix for Malaysia. Question mark, is it a Netflix Malaysia Sdn Bhd?
No.
It's overseas.
You're paying where?
Overseas.
Disney Plus where you're paying? Malaysia ke? Overseas. So operation? Overseas. Your website of course stick in Malaysia. Possible. They might be have some like Malaysia website and all that. Are they taxed? No. But they are taxed through digital service tax. Are you clear? DST. Now who pay the DST? You.
So paying silently lah, sir.
You pay. Not they pay. So Netflix and all of this are foreign players, foreign service provider. They call it foreign service provider, FSP. FSP need to pay digital service tax for whatever service they are giving in Malaysia.
Macam service tax lah, sir.
It's service tax. It falls under service tax. Sales and service tax. They call it DST. Alright? Okay. Are we clear this part?
So according to this table, which one, sir?
But they got no income tax. They are not taxed in. They don't need to pay any income tax in Malaysia.
Oh.
Are we okay now?
So according to this table, no.
Dia tak ada. Kita kena bayar tax nanti.
Tak payah bayar tax in Malaysia. So and if you are Netflix, you will do what Google do lah. Ding dong, ding dong, ding dong everywhere. Everything go to Bermuda. Does that make sense? Here. Okay. But if you have a branch in Malaysia,
Yes.
you are taxed for whatever the branch earns. Okay. Notice tax for whatever branch is earned. Branch income is liable for
Direct to
Malaysian
direct
tax. Are you
Malaysia.
clear on this part?
Ha.
I will stop there for today.
Yay.
Sir, can you send the notes to students?
What notes?
Ah,
I'm not sending notes today.
So please lah sir.
Alright.
Yes.
Okay.
Sharing notes kan?
No, I'm not sharing notes anymore. I stopped sharing notes.
We crying sir. We only have like 2 to 3 weeks.
I'm not sharing notes anymore.
So lesser.
I'm not sharing notes anymore.
So we only have 3 weeks before internal papers.